In this video, we're going to be breaking down some pros and cons of using interest-only loans in your property investing journey. There's a lot of misinformation out there, so hopefully I can bring some clarity as to how you might be able to use interest-only loans to build out a property portfolio and manage your cash flows at the same time. Of course, this video is not financial advice, it's just for education purposes only. Make sure you go have a chat with a trusted advisor to look at your own situation. Now, before we dive into the benefits, let's define what an interest-only loan is. It's where you go to a broker or a bank and ask for an interest-only loan period where you just pay the interest component and not the principal component on a property purchase. The first big benefit here is that you can enjoy lower repayments. So it really boosts your cash flow in the initial instance. The longest interest-only period you can get in Australia is typically 5 years, and you can also ask for extensions on these loans. So obtain another 3 or 5 year interest-only period after you've had an initial interest-only period with a broker or bank. There's nothing stopping you from refinancing with different banks at different points in time to continue on that interest-only train. The real reason interest-only loans are valuable to investors in this cash flow scenario is that you only have to make the repayments for the interest you owe on the property rather than paying down the loan at the same time. Now, why might an investor want to do that? If you're bullish that the property is going to grow in value, then just paying the interest component means that the debt is being inflated away by the asset's value. An example scenario might be you bought a property for $500,000 and you pay, say, $20,000 a year in interest-only repayments. If the property grows faster than your interest repayments, then the debt is essentially being inflated away by the increase in the asset's value. So as the investor, you're paying off your interest bill every month, every year, and as the property increases in value, you're building your net worth over time. Now, the real nugget of gold in this video is if you can find an equilibrium between cash flow and capital growth. If a renter is paying you money and that covers the interest bill on the property, and the property is also growing in value, and you have your property on an interest-only loan, that's where you can essentially hold the property indefinitely for that period of time and build your net worth as the property grows in value. Now, what a lot of investors like to do is buy multiple of these properties, receive the rental income, and cover the cash flow on the interest-only repayments, and wait for the property to appreciate in value. The other big advantage of being interest only is you're maximizing your tax deductions. So interest on an investment property purchase is tax deductible, and if you're just paying the interest component rather than the principal and interest component, you're just paying the tax deductible funds rather than a portion of non-tax deductible and tax deductible funds in a principal and interest repayment. So to summarize, you've got lower monthly cash flow repayments, you're ideally holding that property and letting it grow over time while the renter covers the mortgage, and you're also having tax effective deductions. So what's the big negative with interest only loans? The big concern here is that it really affects your borrowing capacity. The bank's calculators, when they have a discussion with you, really minimize your lending when you're on interest-only loans. Someone that's able to get $1 million of loan on interest-only may be able to get $1.5 million if they were making principal and interest repayments. That's because the bank looks at your level of debt over time to assess whether they're willing to lend you more debt. If you're paying principal and interest, and over time your debt is being slowly paid down, the bank will look on that favorably for your serviceability. If you're only paying the interest on your property, then you're not paying any of the debt down, even if you're building up cash in your offset. Emily and I are at the point where we have a balance between interest only and principal and interest repayments on our home loans. We're looking to maximize our offset account on our owner-occupied residence because that's non-deductible debt, and we're looking to cash flow and have interest-only loans on about 50% of our investment properties. As we look to make our next property purchase, we might want to switch over 1 or 2 of those loans to principal and interest to continue to boost our serviceability and allow us to make our next purchase. For me as an investor, if I could have my entire investment portfolio on interest-only loans, I would, because then I can have the best possible cash flows and wait for the properties to appreciate in value over time to build more net worth. Now, this in practice isn't possible, so you need to work out what balance works for you between principal and interest-only repayments, but it can definitely be used as a great tool to understand your cash flows, maximize your tax deductions, and find a balance in your portfolio over time. If you're looking to make a property purchase up here in Brisbane, I run a buyer's agency called Purpose Property. If you'd like to have a chat with me and a free strategy session, head over to purposeproperty.com.au, drop a like on this video, subscribe to the channel down below, and I'll see you in the next one. Peace.